Okay. Well, welcome everybody. Good morning. Like I said, I hope everybody is staying warm. This morning snow came down. It's been a little chilly. We are into February, so we've been doing these newly elected sessions starting at the end of December. We did all of January, and then we have a few more to do during this month. But unfortunately, this is the last training session that we have set up for the treasurers. That just means that you roll over into the regular treasurer training. But again, Lori and I are only a phone call away, so if something comes up or you have a question about anything that we've went over or even something we haven't went over, give us a call or send us an email and we'll be happy to talk with you. We hope that you guys have gotten this good informative information from this. This has been helpful and useful for you. Again, this session is being recorded along with all the other sessions. All sessions that have been recorded up to this week are out on our website, so if you want to go back and rewatch something, they are available there. And we'll have this one up by the end of the week. We do appreciate all of your attendance, and as you have logged in through all of these sessions, what we have been doing is we've been tracking all of that information. So at the end of February, after we do our last session, we will be putting together certifications. It may take it a little bit to get to you because we do have 4 different groups that we're working with, but you will get a certification letter that shows the ones that you have logged in and attended. If you have watched the recording at a later date, unfortunately, I can't certify that. I don't have any way to verify that it's been watched, so just keep that log for yourself to know that you have watched that. And while you keep track of your training hours, you can log those as well. Okay, so with that, I don't think I have anything further. I'm just glad that you joined us today. I hope that you find it informative. I'm going to give it over to Lori so that she can talk to you this morning about claims and receiving.
Okay, go through my little thing where I try to share my screen and do it quickly. Okay, I need to flip it.
Yep.
Always need to flip it. Okay, let me move my boxes out of the way.
I don't see any boxes, if that helps you.
Okay, should be good then. Okay, so today we are going to talk about receipting and dispersing. And this is for treasurers, although I will be giving the same, basically the same presentation to auditors, because together the auditor and the treasurer perform the fiscal functions for the county. So we've already discussed in earlier sessions, hopefully you were able to see them or watch the recordings of them, but you can go back and look at them. But we've already discussed that the auditor maintains the funds ledger, which is the official financial record for the county funds, and the treasurer is the custodian of the cash and investments of the county. So all money coming into the county, all county funds, which are your receipts, must be accounted for by both offices, and all money leaving the county funds, your disbursements, must also be accounted for by both offices. Since each office keeps their own funds ledger, the reconciliation of the 2 records allows for the detection and correction of errors. The receipting and dispersing from counties is not a streamlined process, but the additional steps involved help ensure the safeguard of the county treasury, of the money that you're holding for the county. We are going to discuss these processes from the perspective of both offices. Again, this is the same presentation I'm going to give to both offices, and it's important, I think, for you to see both sides so you know how they work together. I said we did hold a session called Working Together earlier this month. And again, that session is recorded. You can watch it if you didn't already see it. Some of the concepts discussed in that session are reiterated here, but our focus is on receipting and dispersing rather than reconciling in this particular session. In that session, we did discuss that the accounting process has steps. Just by definition, the accounting process has steps for both receipting and dispersing. The authorization, custody, record keeping, and reconciliation are the steps we talked about. The 2 offices were designed to implement a segregation of duties between maintaining the official records and the custody of the treasury. The auditor authorizes the receipting and dispersing processes as well as maintains the official records, which is the funds ledger. The treasurer has custody of the money in the treasury. Nothing comes into the treasury or leaves the treasury without going through the treasurer. The treasurer also reconciles the treasury as it is carried on the cash book to the bank and investment each month. The cash book holds not only the county funds, remember, but it also holds those property taxes and other sources such as your excise tax, special assessments, etc., that are being held in the treasury. So it accounts for all of the money that is being held. So I listed the statutes again on this slide that govern the auditor's and treasurer's duties for receipting and dispersing. So the auditor issues the quietus, and that's the official receipt that shows how the payment will be posted. The auditor also issues the warrants. And as we discussed earlier this month, a warrant is not a check. A warrant is an order upon the treasurer to pay from the treasury a specified amount to the payee. This could be paid by check, it could be paid by electronic payment, wire transfer, etc. Often, I think most of the time, the warrant and check have merged and they are used interchangeably, but please remember they are different, especially when reading the statute. The statute is not saying that the auditor issues the payment from the treasury when it says it issues the warrant, okay? It's not saying the auditor has the authority to issue the check or the wire transfer or however that payment is made. It's saying it issues a warrant, which is an order upon the treasurer to make those payments. There is a distinction there. And the treasurer takes custody of all collections to be deposited into the county treasury. Until the treasurer has taken custody of the collection, they are not part of the county treasury. We will discuss this later when we discuss the receipting process. But until the treasurer accepts the money and issues a receipt, the money is not part of the county treasury. It is still public funds when it is held by other county offices, but not part of the treasury. And that's part of the reason for the supplemental AFRs, because there's money held outside of the treasury. The treasurer would also pay the warrants issued by the auditor if there is sufficient money in the treasury to make that payment. So when they get the warrant, which is the order to make payment, the treasurer determines is there sufficient money to make in the treasury to make the payment. Basically, you're looking at bank accounts at this point to make sure that those checks can be covered. When we started the discussion on the receipting process a few years ago, for us, it was going back to the basics. We managed to create a firestorm of pushback from both the auditors and the treasurers, and really all of the offices. So you may still find some of these issues in your county. I still say I lost 2 partners because of this, and Ricky was strong enough to hold out despite it. But yeah, there was quite a bit of pushback. What we are guessing is with the use of software, it appears that a lot of the segregation, because of the automation, it appears that a lot of the segregation of duties that had been designed in the manual process had been eroded. It was not the same process in every county, but the lines between the auditors and treasurers' duties were blurred. This was especially problematic with departmental collections within the counties, which we're going to be discussing next. But in trying to work through this, there continued to be misunderstanding. There was a lot of anger, really, and frustration with the whole system. And so sometimes not all of the information was getting through. One of those misunderstood concepts was after we had done the training, was that the auditor's office was never, ever, ever allowed to touch money. And that is not true. We never said that. That is not correct. The auditor should not take custody of collections from departments or other payments into the treasury. Take custody of them. Doesn't mean they can't touch them. They cannot take custody of them. However, there are fees that are collected by the auditor. Copy fees from their office, map fees, endorsement fees, sales disclosure fees, recording fee for the tax deeds are all examples, and I've listed statutes here, and the statute specifically says that the auditor takes the receipt for these fees. So the auditor is allowed to collect these fees, touch that money. In this case, they're going to post them to their auditor's fee book, and then they would be paid into the treasury using the receipting process that we're going to go over, the same as any other department would, other than it's starting with the auditor instead of the health department or park department, okay? We will be focusing on departmental collections as the most payments by your citizens, other than property tax payments, are paid to the various departments. So most people, when they're paying, they're going to the health department to get their birth certificates, the parks department, the recorder's office, the clerk's office, the sheriff, or building departments. They're not coming in to make those collections directly to you guys. And so it's those receiving where they're coming, where those departments' collection points are then funneling that money into the county treasury that we're going to be focusing on. There are still some payments by citizens that may use the quietus process. Depending on your county, you might have buggy permits that are paid at the courthouse and maybe not at the highway or sheriff. You might have peddler's license or something like that. But mostly we're going to be talking about departmental collections. Then on the treasurer's side, there are payments that are made directly to the treasurer without going through the receiving process when those payments are made. Property taxes is the biggest. Property tax, there's a bill that goes out, they make those payments directly to the treasurer. There is no quietus process at the point of payment. The treasurer collects and records the property tax payments made, summarizes those payments by taxing district on their cash book until settlement. It is at settlement that the quietus process comes into play, and those collections are then moved into county funds for distribution. So these collections are only carried on the treasurer's records until settlement. So for the payments after collection and prior to settlement, the treasurer does hold the official record for those payments. That's why the treasurers have to do an after settlement collection supplemental AFR report to their auditor to report what collections they're holding at the end of the year. Additional things that are paid, excise taxes from BMV or from the state, special assessments, sewer liens, these are also collected directly by the treasurer and posted to the cash book until settlement. The innkeeper's tax is also collected by the treasurer's office, should be quietus into a county fund used by the Tourism Commission, so you're not necessarily going to carry that on the cash book, but it is a payment made directly to the innkeeper, by the innkeeper to the treasurer. Sorry, I'm already moving to the next slide. I think I am. Okay. So let's go back to the payments into the county treasury that are not part of property tax collections or tax collections. Again, these will mostly be made by the various departments that collect fees for county services, the licenses, permits, etc. It's possible that fees are assessed by local ordinance, again, something like the buggy fees or peddler's licenses or something that you might collect, but those aren't very common. Step one of the process is to prepare the application to pay. This is the name of the manual form that was designed somewhere in the 1940s. I have the t-shirt to prove it. I don't think we've heard of too many counties that are still using the manual form, but that is the name of the manual form. We don't care what you call it. You can call it application to pay. You can call it pending quietus. Some counties call that. We don't really care about the name. We care about the process. So however your system automates it, the process should be protected. The names are not that important. But I'm going to call it that because that's what's the manual form. So the application to pay would show the date, what funds will receive the collection. So is it going into general fund? Is it going into perpetuation fund? Is it going into another special revenue fund? Who's paying? So the source of the collection. So if it's, the health department or the recorder's office, who's bringing that money in, and, whether it's birth certificates or marriage licenses or where this money is coming from. So for example, you might have an application to pay or a pending quietus that shows today's date. It might show the money is going to the general fund and a certain amount going to perpetuation fund and the total amount collected and the source being recorder collections. That's, just an example of what an application to pay might look like. The department would have prepared a form called a report of collections that breaks out the collections to the appropriate amounts for each fund that is to be credited. So every department that's bringing money in is going to be doing a report of collections. That ensures that the money gets posted to the right funds, the right revenue lines. The auditor reviews the report of collections to make sure that the funds and the revenue lines are appropriate. The report is mathematically correct and completed before starting the quietus process. So they're auditing that report of collections for you, okay? Some counties have the departments email the report of collections to the auditor's office so the process can be started, and then actually bring down the collections when the auditor lets them know that they've audited the report and it's ready to go to the next step. And the next step then being turning the money over to the treasurer, which we'll go over on the next slide, and that's fine. You can look for ways to make it easier within your county, and certainly automating or using electronic forms is one way. The auditor is not required to count the collections, and this is probably the source of the misunderstanding that auditors can never, ever, ever touch money. There is nothing to say that the auditor can't count the collections or look at the recorder's check to make sure it matches the report of collections. Well, what they cannot do is take custody of those collections. And I'm going to give you a historical perspective. I hope this helps make sense. And what we told during the last few years when we've been doing this training, we did not discover that there were problems with this process because auditors and treasurers were being written up in audit reports. That is not how we knew there were problems. We knew there were problems because auditors and treasurers were calling us and saying, what do we do now? Okay, so for example, I had an example. So example, a treasurer calls up and says, the auditor's office brought over the collection with the pending quietus and the collection's $200 short of the quietus amount. What do we do now? Question, 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 question. And of course, what we're thinking is, well, why would the auditor have the collections in the first place? That isn't part of the process. So we realized after more than one person called with these kinds of questions that we need to do some additional training, some back to the basic training. So we started training again on the receipting process. And from an audit perspective, so this is how we're going to view this during an audit, the money is not part of the treasury until the treasurer accepts it for deposit and provides a treasurer's receipt. So as a result, from an audit perspective, if the department drops off their collections and report of collections with the auditor and walks away, and the auditor gets around to processing that and then brings it over to the treasurer, and the collections don't match the amount on the report of collections or the pending quietus, the shortage is held against the department. Even though there's really no clear determination of where that shortage occurred, the department is responsible for those collections until they have the treasurer's receipt. And if they are short to the total receipt amount on the report of collections, they're going to be held responsible for that shortage. It's for us, and this is an absurd example for us, that the fact that they dropped it on the auditor's counter is no different than they just dropped it in the hallway. They're responsible until they get that treasurer's receipt that money's been turned over to the county. On the other side, we had treasurers call and say they were having trouble auditing the report of collections. And again, our thought was, why are you auditing the report of collections? That's the responsibility of the auditor. Departments need to start with the auditor first. We do not expect the treasurer to start the quietus process and should not be. It is the auditor that's going to post those funds. So they need to have the report of collections and make sure that it documents where those funds need to be posted and that it's accurate, mathematically correct, everything we've just talked about. Once the document, whether you call it the application pay or the pending quietus, has been prepared, the actual collections must then be taken to the treasurer by the department or the payee, not by the auditor staff. Again, the auditors should not be taking custody or responsibility for that money. It goes from the department to the treasurer. We know this process is not efficient. We've heard it, but it serves to safeguard those collections and make sure they are receipted and deposited properly. In our earlier example where the collection was short, where did the shortage occur? Did the department make an error? Was money taken from the collection at the department's office? If it sat in the auditor's office for a few days or longer, did someone have access to that collection and take money from it? Is it part of it still sitting in a drawer somewhere in the department's office or the auditor's office? We don't know, because there's no clear chain of custody from the department to the treasury. So to avoid this, the report of collections is reviewed by the auditor, and immediately the collection is counted, receipted, and accepted by the treasurer for deposit. When the treasurer hands that receipt to the department, that is the department's proof that the custody is passed to the county and that the treasurer has taken responsibility for this money and will be making the deposit. The department then is no longer responsible for that money. So some software allows the forms to be created electronically and then transferred between the offices rather than someone having to walk an actual document back and forth. That's fine. We don't have a problem with that as long as there are controls in place that prevent someone in the treasurer's office from initiating the quietus process or someone in the auditor's office to complete the whole process without the input of the treasurer, that the collections have been received for deposit. The segregation of duties have to be maintained. So access to that electronic form, there've got to be controls built into the software to make sure that each side performs their duties and doesn't cross over into the other sides. It is okay to set aside a time for these collections to be received so you don't interrupt the flow of your office or require anyone to wait too long to get the money. We talked about sending the report of collections electronically. The treasurer could set up a time that they'll do department collections on a certain day at a certain time, so that you can get them in and get them out. You could set, if it's during a busy time, you can set somebody aside just for that hour or whatever long it takes to do those departmental collections, so someone's not standing there for a long time, because we realize that everybody has work to do. So remember, the auditor is going to post a ledger for the appropriate funds, and the treasurer is going to take custody of those funds. Once the treasurer issues a receipt, that needs to be communicated to the auditor, either electronically, as we talked about, or the payer actually walking the receipt back over to the auditor. With the receipt from the treasurer, the auditor can complete the quietus process and issue a quietus to the payer or department, post the funds appropriately based on that quietus. The treasurer already has received the application to pay or pending quietus, so they have a copy of it. That allows the treasurer to post their funds ledger with the same information that the auditor is using. Again, this is not a streamlined process. We get that, but these extra steps are served to address the risk to safeguarding the county assets and providing accurate reports. So at this point, the payer or the department person that's bringing in those collections now holds the treasurer's receipt and the quietus that tells them how that money has been posted, so they can track it for the funds that they're using. So to summarize, the auditor has the information necessary to post the funds ledger, as well as proof that the treasurer has taken custody of those funds. The treasurer can make their deposit and has the information necessary to update their funds ledger from the application to pay or pending quietus. The person paying or the department has documents to show how the collections were posted for their records, as well as proof of that the custody of the collections has been transferred to the county treasurer. Whatever system you use needs to provide those same results, that all three then have the information they need to do their job. And we talked earlier about ACHs and electronic. Again, there has to be cooperation between the two offices. The difference for electronic payments is there isn't an actual deposit that needs to be made. The deposit's being made in the bank by an outside, whether it's BMV or the state. So you have to have procedures in place to do the quietus process. You just don't have to worry then about the actual deposit being made. Now let's flip around and look at the dispersing process. This is how money leaves the treasury. And just as a note, before we begin, we noted that the office and department, even the auditor's office, are collection points for the county receipts. However, all claims must be processed through the accounts payable process with few exceptions. So even though they can, different offices are delegated to be a collection point or to receive money in, claims have to go through the accounts payment process. There are offices that are authorized to have funds outside of the county treasury, such as the sheriff's commissary fund, the clerk's trust fund. Disbursements are made from these funds under the direction of the sheriff or the court or clerk or the court. But even for these departments, they should not be paying for operating expenses from those funds. The county sheriff can supplement their operating costs from the commissary fund for specific purposes outlined in statute, but they can't use the commissary fund to work around the accounts payable system. They should not be using their commissary fund to pay expenses and then getting reimbursement from the county. They need to use the county's accounts payable system. Then you have trust funds, which are like the clerk's trust fund. These are held in trust for others. They're not used to pay any operating expenses, but they are used, again, they're going to be paid out either to the appropriate payee, whether it's the person that paid the money in or someone that's court ordered to receive that money. So all of the claims for operating expenses need to come through the accounts payable system of the auditor and treasurer. So I listed the steps of the accounts payable process on this slide, and we'll be going through them in a little more detail. Departments can initiate claims because they have operating expenses. They have operating budgets that they're using. However, the auditor must audit all of the claims before any payments can be made. Once the auditor has audited the claims, they must also be approved by the governing board. This is usually the Board of Commissioners. However, other boards can approve claims. The Redevelopment Commission approves their own claims. Tourism Commission, Drainage Board, courts, all of them have the authority to approve claims rather than the commissioners, not the auditor. The auditor is still auditing those claims, but it's the board approval that could be through another board besides the commissioners, but most of the time it's going to be the commissioners. And the remaining steps, again, remain the same for those claims. The auditor prepares the warrant. Again, remember, that's the order upon the treasurer to pay a set amount. And then the treasurer has to determine if there is sufficient money to pay the warrant or series of warrants. In most systems, the actual checks are created from the software. However, those checks require the signature of both the auditor and the treasurer to be valid. It is possible to use an electronic signature that is affixed to the checks, but, and this is very, very important, the check should not be issued until the treasurer has determined that there is sufficient funds to pay those warrants and approve them for payment. You need to control how your signature is attached to those checks, and that those checks are not issued until you have, as treasurer, have approved those payments. And then the auditor posts those payments to the funds ledger. The treasurer will also post the same information, the treasurer's fund ledger, because you have a check register, you know what's been dispersed, and then those should mirror each other. But only by reconciling can it be verified that those two ledgers do have the same information. So if there's a posting error on either side, it's the reconciling that's going to catch that. So let's look at this disbursement process in a little more detail. To issue a warrant, the auditor must have a valid claim or an account payable voucher. They can't just say, write a check to Joe Smith for $25. There's got to be supporting documents for every check that is issued, for every warrant. So that supporting document should be attached to an APV, an accounts payable voucher or claim, and it should show who's getting paid, so the payee and the amount, their address, the amount to be paid, the purpose for the disbursement, certification that the goods or services have been received, the appropriation to be posted for this claim, and then you have payroll claims. These are completed by departments and processed by the auditor's office. They show each employee and the amount to be paid based on salary or hours worked, the salary ordinance, and what appropriation line those payroll checks are going to come out of. We have prescribed forms for this. The Form 17 is for vendor claims, and the payroll form is Form 99. Of all of the forms that you see, the Form 17 is probably the most common manual form that's still being used, and sometimes the electronic form is an exact duplicate of that, but more and more electronic versions are being used. The claims, again, are often initiated or completed by the department or offices outside of the auditor's office, but all of those claims must come through the auditor's office for processing. So I've given you a screenshot of the Form 17. I apologize. I could not find one for the counties. I know I have one at the office, but I did not have an electronic version. So this is city-town version, but it's the same form for each. This one just says city-town on it. So the person completing the form, again, must list the payee. So I'm going to put the payee's, the vendor's name and address on here. They're going to put the invoice date, invoice number, any other descriptive information on that, a description of what was actually purchased or services received, and the amount. They have to sign for the department person or whoever's the purchase manager for the department would then have to sign, could be the department head, could be someone else designated, that they received these goods or services. They're certifying that the county's already received this because you don't want to be paying things in advance. And then on the back side of that, there is a place to put what account number, what appropriation you're going to be paying this from. And it is possible to pay one claim for more than one appropriation line. So you could have one invoice, for a set amount, and you could split that between, say, general fund and a perpetuation fund or something similar to that. So it is possible to do that on one claim. But the claim, then the auditor's office is going to document on that claim what warrant number was issued. The approval is usually done on a claims docket rather than on the individual claims, although I suppose there are still some that might have, especially if it's coming from another board, might have the individual signatures of the board members. So when the claim is received, the auditor's office needs to audit the claim. So here are the items that they're going to be looking for. Is the claim properly itemized and verified and properly supported by invoice or supporting documents? If it doesn't make sense to your accounts payable clerk in the auditor's office, it's not going to make sense to our staff during an audit. So make sure that it looks complete and looks reasonable. I actually once saw a mileage claim that had the payee employee's name, a date range of something like January to April, and just a dollar amount. There was no itemization of the mileage travel. There's no business purpose for any of that. So that is not an adequately itemized claim. That was a really poorly itemized claim. It actually got paid. I was surprised. But that's the kind of stuff that the auditor's office should be stopping and asking for more information on. Payroll claims are also audited against the salary ordinance or any other supporting document for salary and wages. Maybe they're under a contract or something else that would determine the amount paid. For any itemized claim, the auditor needs to determine that the charges are consistent with contracts for those purchases if a contract exists. For example, if there's a contract for the purchase of salt during the winter, then the charges on the claim have to be in compliance with that contract says they're going to charge for the salt. As an example. The accuracy of the claim needs to be determined. If 12 units are purchased at a certain price, then make sure that the total on the invoice is 12 times the unit price. If the quantity received is the amount being paid for. If the department notes on the claim that only 5 of the 12 items were delivered, make sure the county is only paying for the 5 items. Payment in advance of receipt of goods or services is not allowed unless there is a specific law that provides for that. Then was the claim approved by the appropriate official or department head? Has it been approved by the governing board? Again, has the purchasing, whoever is designated for that department, signed off on it? And have usually, again, the commissioners, this goes to them, usually on a claims docket. But if it's another, if it's a redevelopment commission, has that board signed off on it? It's very important that all of these steps be followed. And then the sixth one, which is very, very important, is there sufficient appropriation and sufficient balance in the fund to pay this claim? If there is either insufficient appropriation or insufficient fund balance, the claim can't be paid the way it is completed. So the auditor is going to have to work with the department head to find another appropriation line to use or another fund to use. And we discussed this when we talked about the session on budgets, appropriations, and encumbrances for auditors. And again, anybody can watch that. But you should not overspend an appropriation or have a negative fund balance, with the exception of reimbursement grants. So as a department, you should be watching your own budget and making sure that you're staying within the appropriation allowed for your departmental budget. Again, each department is responsible for tracking their own budget, should be aware of their unspent appropriations and the fund balance. So as treasurers, you should know how much of your budget you've used for your payroll, how much is left. If you're not tracking it yourself, you'd be getting reports on this. Your software can generate reports. You may have read-only access to see what where your budget lines stand. And again, if there is insufficient fund balance, then the claim should not be posted to that fund. It should not cause a fund to go in the negative. We do not want to see that, unless it is a reimbursement grant. Then, before any money can actually leave the Treasury, the treasurer must authorize the disbursement. This is by check, electronic transfer, wire transfer, however it's going to be paid. For example, payroll is often done as a direct deposit, so the auditor's office may even prepare the transfer information from the county's bank account to the employee's bank account. However, the treasurer should first review the total amount needed for payroll, determine that the payroll fund has sufficient money to pay out this payroll before that transfer to the direct deposit is authorized by the treasurer. It is not enough to give the treasurer a copy of the report after the transfer is done. The treasurer has to authorize the payments before. They have to be able to make that determination. They should not have to guess how much money is needed in a specific bank account. So if there's transfers needed from, a main checking account to, say, the payroll account, they should know how much they need because they're going to know how much is going to go out. Okay. What the treasurer does not have to do is re-audit the claims for any reason. You only need to determine that there is sufficient money in the account to make the payment before the payment is made and authorize those payments. So you don't need to look at the claims for reasonableness or accuracy or anything. All you're looking at is this is the total amount that's going to come out of my, whichever bank account, First National account, and what's going to come out of my, union account, whatever account you're doing. But you're just making sure there is sufficient money to cover those checks. You do not want any bad checks issued by the county. And then on the flip side, someone in the auditor's office should not have the authority to transact business at the bank to the extent that they can authorize payment. So that payroll person putting together, say, the transfer information for direct deposit should not have the authority to authorize the actual transfer of money between the payroll account and those direct deposits. That has to come from the treasurer. And what we do not want the treasurers to have to do ever is find transactions or withdrawals from their bank accounts that they had no idea were happening, that were made by the auditor's office. And that has happened, and it has caused problems. The auditor should not be able, no one in the auditor's office should be able to make payments or disbursements or any kind of withdrawals out of the county account. That has to be the treasurer. Again, the auditor is responsible for maintaining the official records of the county funds. That funds ledger is what's posted again, is uploaded to Gateway and makes the basis of the annual financial report. And that's what we're going to audit, is the auditor's funds ledger. Okay. They would also post correcting entries, transfer of funds, voids for checks. But if they do that, they should be giving that information at the same time to the treasurer. So, the treasurer has the actual copy of the quietus. The treasurer has the actual check register to know what's coming in and going out of those county accounts. So if there's corrections or transfers that affects the funds themselves, it doesn't actually, a movement of money in and out of a bank account. They should still have that information so they can keep their funds ledger up to date so that you can reconcile. If you don't post those, that makes reconciling really, really, really difficult. And once a month, at least, those two records need to be reconciled. And that way you can determine any variances. You can research those. Where is the posting error? Were there some voids that didn't get reported to you? Were there things or checks that didn't get properly posted to the funds ledger? All of that information can be pulled together and any corrections can be made. That's a very, very, very important part of what you do in your office every month. Reconcile those funds ledgers between the two offices. So the two offices must work together to properly receipt and disperse funds from the county. The segregation of duties should not be eroded. We know that sometimes, and this has happened historically over time from both sides, one office may be a little stronger, quote unquote, than the other, or more experienced. And so sometimes, the auditor kind of steps in on the treasurer to take over some duties because the treasurer is not sure of it. And another county, maybe the treasurer steps in and does some of the auditor's duties for the same reasons. We know this happens, but that should not set precedent as this is the way we've always done it. As newly elected, you are in an excellent position to look at what's being done in your office, question some of these things to make sure that as treasurers, you are keeping your responsibilities for custody of those funds, that money is not coming out of your accounts without your express permission, without your authority, and that money is not being deposited without you knowing about it. So all of that, you have controls over that. So make sure as treasurers, again, take a look at what's being done and question it. We have had newly elected, was another way we found some of these issues with the processes, newly elected officers calling us in and going, this is the way our county does it. Does that seem right? And sometimes it was okay, and sometimes it was not right. And so, you're in an excellent position to at least question that. You have to maintain the segregation of duties between the offices. Okay, so very, very important. And that is the end of my presentation. Are there any questions?
Good. Okay, let's see. I am now going to give you guys control to your microphones and your cameras.
Anything I have to say is
I have muted everybody.
It's the same response we had when we did this at the conference.
We now have to have a report to go. The treasurer has to submit outstanding checks at reconciliation. We didn't used to have to do that. We started that in November or December.
Somehow.
If she goes in her system and clears things in advance, it won't give you a true thing.
I think that was Roger. Let me see here. I am muting everybody, but you can unmute yourself if you have a question. That way we don't have that sound going on. Everybody competing. Does anybody have any questions? Feel free to use the chat box if you would rather do that. But right now is the time to ask questions. And this, like Lori said, has been a huge topic. Lots of discussions have come from this. It can get complicated. I mean, it just can. And if you don't even want to ask the question, you could maybe give us some feedback. I do want to say that I do plan on putting probably some kind of survey together to send out to everybody. It'll be at the end of February when we're done, just to kind of get a feeling if you felt like this was, a good tool for you, changes that can be made, that kind of thing as well. Anybody? Any questions? No one's even turned their camera on because they're so.
They're just,
I got one. Receiving process. Does it require signatures on the forms?
I'm not exactly sure what you're asking, but there has to be something to show that you authorized it. So whether it's electronic signature or an actual signature or initials and a date or something, there has to be a control in place that shows that you have looked at it and authorized it.
Okay, disbursements. We stamp our checks, which gives auditors authorization. Give me an example of what type of authorization for an ACH. Payroll is instant. Don't know how we would authorize.
Okay. What I'm saying is, when you sign that check, you don't want to sign a blank check, okay? When you sign the check giving the auditor authorization to pull that money from your account, you have to know that there is money in that account to be pulled. And so you need to know, if it's payroll, what's total payroll? If it's $500,000, is there $500,000 in your payroll account to pay this out? These are steps you should be making before the system should not just automatically affix your signature to that. You need to control your signature so that you have to go in and perform your reviews before that signature is issued or before those checks are printed or something that controls that those cannot be issued without your approval. They can't do an end run around you as a treasurer, okay? ACH would be the same thing. The bank should not be authorizing any kind of ACH or electronic payments without your specific authorization. You know, it has to come from you, just like the check has to have your signature.
I saw Ed's name pop up, like he wanted to say something.
Yeah, hi, Ricky. I do have a question. It seems like this is purposely a double check or a double check to make sure that everybody is aware of the situation on any financial transaction. So we should not go about trying to streamline that. We should keep it as complicated as it is. Isn't that a good faith?
Yeah. There are ways to streamline, but you should not erode the segregation of duties. I was talking about there may be ways to use electronic, you know, transfer of information between the two offices, or you don't, you know, so you don't, I mean, in the manual environment, like with the quietus process, you know, you've got someone actually stomping from one office to the next and back and forth, and people really get upset about that. You may be able to do that electronically, but you still have to maintain the treasurer has taken custody of those funds, has issued a receipt, and has taken that money for deposit. You don't want the auditor taking that responsibility, because that's not the auditor's job. It's the treasurer's job to do that.
Well, I just see the use of an electronic signature on the checks that possibly could bypass that. I mean, to let the check go out because the auditor's office has my electronic signature.
And that's why I'm saying you have to retain control of your signature, just like a signature stamp. You don't just hand that out to anybody with some blank checks and say, you know, go ahead and stamp. It's the same thing. You know, we realize that the automation system can, you know, do we think you have to sit there and sign 600 checks in a row? No. I mean, obviously that automation is streamlining the process, but you have to have control. So there's a process for you to go in and say, okay, I've looked at this checks register. It's going to take, you know, $1 million out of my account. We can cover that. I am authorizing my signature to be affixed to all of the checks associated with that, or I'm authorizing those checks to be printed and issued. And something has to stop the process until you give that authorization.
Okay, and then one final question. Does my chief deputy have the authorization to do that, to allow those checks to be printed?
You can delegate that. You're still responsible for anything your signature's on. You can delegate that to someone else in your office, not in the auditor's office, but somebody else in your office. You need to keep that segregation of duties going.
Okay, thank you.
Mm-hmm.
Good questions.
There are no bad questions. When we told this at both the auditors and the treasurers, I heard language I'd never heard before. It was shocking. So, you know, you're not going to shock us now because we've already been shocked.
You might shock me because I wasn't here when that happened.
Yeah, I had partners actually ducking behind the podium. It was like, oh my.
Anybody
else?
So
it's all clear. Everybody gets it now. Or why we're even saying this.
I'm looking. I don't see anything. Anyone, just anything else. The T. Elaine, I'm not.
It posted before she got a chance.
I froze water, did she? Okay. Treasurer's office is in control of all accounts.
Bank accounts, investments, yes. Should the auditor be a signer on the accounts? They sign the checks, but they should not be a signatory on the account itself.
You guys are just two heads, or two sides of the same coin. That's what I always like to think about it. Everybody has their own responsibility.
We have had issues where a treasurer has called us and said, they saw something on their bank account and then we start doing an investigation and finding out that the auditor had the authority to call the bank and issue payments, and that should never have happened. Should treasurers watch other departments' webinars? You are certainly welcome to watch any ones you think might be interesting. If you have the time, that's certainly, especially the auditor side. We try as much as possible to do auditors and treasurers kind of more mirroring each other because you do so much together.
Others' webinars more important to us than others.
I would say the auditors would probably be the ones you'd be most interested in.
The others, for the other departments we've done, are kind of a mirror of what you've heard, but at a smaller scale. So like tomorrow I'll do this, not really this presentation. I'm going to do claims and receiving for, I think, recorders or tomorrow. But it's not at the level that this is because they're not actually doing the process.
You can close a checking account and move to another bank. You're going to have procedures in place to do that. You do not need your commissioner's approval as long as it's a designated depository for your county. So your Board of Finance will have designated what depositories you can use. But whenever you close a checking account, you can't just close it out if you have outstanding issues. So there are procedures you have to follow on that. But as the investment officer for the county, you can choose which bank you want to use with. Yes, checks are good for 2 years.
Give a second, see if anybody else is typing. Wish you got the little dots. Like somebody's typing so that I would know.
Yeah.
And I'm sure you guys will hear more and more on this, in the next 4 years too, because we tend to, the big topics like processes and stuff we come back to quite frequently. Anybody else? There's one. So if the account hasn't been used in 2 years, we can move it?
If you have no outstanding checks that have not, after 2 years, you take your outstanding checks and you pay them back into the fund that issued them. And so if that's been done and there are no outstanding issues, then yes, you're going to close that account. You're going to move any balance to another account. You're going to keep a record of that for audit because they're going to need to be able to trace that account was closed and the money was moved over to the other account. You're welcome.
We got a nice sized group here today.
Yeah, good.
Quite informative. Very good job. Anybody else? Well, like we said, you can contact us anytime. You can send an email. You can give us a call. We'll get back to you as soon as we possibly can. and hopefully be able to answer any other questions that you would have. Or, hopefully we'll get to have in-person conferences this year.
And now that you're transitioning over to those those conferences, if you have any ideas for training topics, don't hesitate to send them either to your association or to us.
Yes.
We keep all of those, and we try to work as many as we can in there. So if there's a problem you're having with a particular topic or something, we will try to work that into training.
Absolutely. Okay. Well, I'm not seeing anything else. Well, we really do appreciate you guys tuning in the last few months to these. We hope, again, that they were beneficial to you. They will remain up on the website, indefinitely for right now, and so that you guys can watch them whenever you may need, or if you need somebody in your office to watch them as well. We've had that question asked a lot. Can my deputy watch? Or absolutely, they're open to everybody. Anybody that wants to watch can watch them. Okay. Well, if there's no other questions, we will release you guys for today. We again appreciate your attendance. Again, we hope you got a lot out of it. We hope you got a lot out of the sessions as a whole. And, welcome to the Treasurer's Office.
Congratulations.
You got this.
You got it. You can do it.
All right. Thanks, everybody. Have a good afternoon.